This year's PBoC marketing efforts to incentivize all citizens to buy gold was benchmarked at the Western diluted gold price at plus or minus 1,950 to 2,000, because it's a volatile market. And up until the commencement of the Chinese Golden Week holiday thinned out liquidity as they exited last Friday, the SGE had evidenced a premium that really closely mirrored the equivalent US dollar denominated entry price of around 1,950 to 2,000, with the SGE has at times commanded over $120 per ounce premiums over Western denominated gold.
The gold market is not seeing much reaction to the latest numbers as the market continues to hold support near a 7-month low. December gold futures last traded at $1,833.60 an ounce, roughly unchanged on the day. AndrewMaguire, a respected figure in commodities trading, discusses the PBoC gold campaign and a $2,000 per ounce benchmark amidst market volatility. Chinese demand for the yellow metal has been propping up gold, keeping prices not far off their all-time highs despite massive headwinds. The People's Bank of China has been buying gold at a torrid pace for nearly 2 years now. According to updated foreign reserve data, China's central bank bought 29 tons of gold in August, lifting year-to-date purchases to 155 tons. August also marked the central bank's biggest purchase since December. Maguire highlights China's broad gold investment initiative, focusing on smaller denominations for all citizens. Just 10% participation could strain global gold supply, leading to price volatility. The PBoC opened the facility for citizens to convert renminbi cash savings held in the public's own bank accounts to be converted into physical gold at the click of a button. For context, China's population is currently 1.5 billion people. The top 5 Chinese banks have over $103 trillion in assets, making their assets around $14.86 trillion. This new move will send ripples through the global physical gold markets, which is already being felt by dealers in London. Maguire foresees China's gold promotion, leading to higher prices, prompting bullion banks to prepare. China added to its gold reserves for an 11th straight month in September when a surge in local gold premium drew market attention. Bullion held by the People's Bank of China rose by 840,000 troy ounces in September, according to official data released Saturday. Now, we are presenting the clips of AndrewMaguire's insights from his recent interview with Kinesis Money. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Let's just revisit what we're seeing now and also update our China threads, which we started in the spring. And just ahead of China moving into their first week, the 1-week golden holiday last Friday, and they're obviously absent, it was no coincidence that the PBoC opened up the import spigot into the dips sub 1900. And with that in mind, with China away for Golden Week holiday, let's actually revisit and update what we're hearing from our very well-connected Chinese contacts. Now, back in March, we looked in detail at the second large push by the PBoC to add a click of the mouse physical gold purchase facility to everyday citizens. So, in other words, they have an RMB bank account with a mouse there to click, and they do their banking on it. And what it did was open gold up as one of those options, making it easy for less wealthy citizens to be able to convert RMB into physical gold. Now, and just as they did in their first well-published 2010, you remember the TV and billboard marketing push, massive billboards the size of houses on the side, buy gold. I mean, this was focused on incentivizing the wealthy citizens to purchase bullion bars and coins. This is like size. And the second and wider reaching gold accumulation push this year has focused on incentivizing the less wealthy masses to regularly invest in gold grams. This gold investment scheme is open to all 1.4 billion Chinese citizens. Now, the average savings rate is around 30 to 40%. And with the PBoC incentivizing gold into this RMB saving mix, it is suggesting citizens convert at least some of these RMB cash into physical gold every single month. Now, let's just think about it. Look, if just 10% of the population bought a single gram per month, that would on its own consume 1/3 of global supply for gold in just 1 month. And let's be more conservative. If 10% of Chinese citizens converted a single gram just once into the Lunar New Year in 2024, which is their gold buying season, it would consume 1/3 of global gold supply. Now, so putting that into context, people don't think about this. So the question is, where would this excess bullion supply to feed this trade come from? The answer is it would have to be sourced out of immediately deliverable above ground supply, global supply. And at what price? Well, the answer to that is certainly not a paper price. And first-tier bullion banks exposed to this radically changing supply-demand imbalance, they're aware of this. And they're aware of the impending supply-demand imbalance. And they are gearing up for a much higher gold price, and are long for their own books. Now, the gold price will actually be determined by a physically settled supply-demand balance. I mean, in other words, the price a global seller is actually willing to part with their physical gold in exchange for either cash or other goods, such as commodities. Now, in other words, the only remaining paper-settled futures market, which is the COMEX, would have to become deliverable, or it would be raided for every single last leverage ounce it has in its system.
Maguire underscores a worrisome paper-physical gold market disconnect, anticipating possible deleveraging. The current fall of gold prices due to leveraged paper market activities can increase demand for physical gold, supporting trillions in commodity trade. Furthermore, Maguire expects central banks to deliver gold, while the unwinding of speculative positions benefits the Fed shorts. Gold prices climbed to near historical high levels this year as central banks and investors continue to purchase the commodity to hedge against inflation and economic uncertainties following the COVID-19 pandemic and war in Ukraine. Let's get back to the interview.
September's officially driven third quarter slam down, the sheer scale of this paper to physical disconnect has reached really untenable levels, and at the margin again is undoubtedly going to force Western paper market deleveraging. Now, outflows of physical gold underpinning the fractional amount of US-centric gold are unseen by the blinkered speculators who are just auto-selling fiat gold against a rising dollar simply by an algorithm that says buy dollar, which is fiat, sell gold, which is fiat gold, because it's not real gold. So it's a simple little game. Now, as far as the inverse dollar gold algos are concerned, the ones that we just described, the end of the third quarter ramp in the dollar and the yields has driven a mass capitulation of paper market long bets, paper gold bets, and ramped up short bets, i.e. people who are saying, hey, I bet lower and I'll just chase this dot down. And they are driving the COMEX paper to physical disconnect to absolute extremes. And as we mentioned earlier, the ramp in treasury yields alongside global yields hitting record highs has driven speculators to race into cash and the dollar, reaching November 30, which the dollar has reached these November 30th highs. And we saw that happening overnight. And to provide context, on November the 30th, gold futures were trading at 1,758. Although it bottomed in the 1,600s in November, actually on the 30th, this is where, and we're trying to apples, dollar price to where gold was at that point, 1,758. Illustrating, though, the paper market bleed out of this inversely correlated algo. And also, we were benchmarking silver at 21,355 on November the 30th. So just to provide a little context. And following the end of week meetings with first-tier liquidity providers last over the weekend and again last night, despite hawkish Fed spin driving yields and the dollar index higher, the consensus is that the rise in bond yields is perceived to actually be taking pressure off the Fed's current hawkish spin. So really, again, just automated selling based on headlines and really no one looking any deeper. And as a wall of long, this is important, a wall of long T+2 central bank spot gold positions will now have commenced the NSFR delivery process. And the spec long clean out has led by spec long clean out and led by the nose, these long dollar short gold positioning has provided the Fed some very large short cover into this raid. But while very short term, these official short bets have been largely squared off inside the non-delivery COMEX exchange against the specs, on the other side of this trade, liquidity providers holding offsetting longs in the spot delivery markets will be forced to deliver physical gold against the spillover of very large unwind of leveraged sales. Now, with non-sticky speculators largely capitulated. Now, remember, there are some sticky speculators, commodity trading advisors, who recognize that even paper gold has become a first-tier asset class. So really, they don't get rinsed. So it actually reduces the amount of bandwidth that the insiders get to play with. And even though they've borrowed these positions from the house, they're doing it's a function. They are actually a hedging function. So they're not easy to rinse out. But those with the non-sticky specs capitulated, all their longs are gone. The downside is being driven by fresh dollar index backed naked short spec positions, which are vulnerable to the house.
Shanghai prices were about $10 an ounce above international prices at the close, according to calculations by Bloomberg. This month, premiums had risen to a record of over $120 an ounce. The gold market evolved with China's gold campaign and the People's Bank of China's purchases. Following the global economic uncertainties, gold remains a safe haven asset for investors. How might the evolving dynamics in the gold market impact global economies and financial stability? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more exciting topics. Thank you for watching.